to our first virtual launch of the monetary policy review. This is the first time that we are doing it in this format due to COVID-19 and the fact that we must practice, all of us, social distancing. Most of the staff of the Reserve Bank are working remotely, and only the most essential ones are still doing some work in the office. I think that MPR becomes important in a number of ways. Firstly, is that it takes place in an environment where forecasting has become nightmarish because there are so many moving parts that are at play here, and we are faced with a situation where we have got to present a forecast in this particular environment. When we had our first MPC, the country was not in a lockdown, which basically means that the forecast that we presented at the March MPC has become outdated. We had to take the kind of action that we have taken from the monetary policy side. Firstly, because we had the monetary policy space, inflation was contained, but also the MPC of March took place in an environment where South Africa had just gone into a technical recession. And the day after the MPC, we took further steps which had been under consideration for some time, for at least 2 weeks prior, where we got an indication that there was some dysfunctionality that had started to creep into the South African financial markets. And we then took the steps to extend the Repo facilities that we have. We introduced an extra Repo window in the afternoon, in addition to the supplementary, in addition to the final Repo that we avail for the banks to square off their positions at the end of the day. We also at the same time announced that we would actually be going into the bond market, where we had identified that not only have the dysfunctionality set in, that there was a drying of liquidity to the point where very small amounts could actually move yields in a significant way. So we provided the Repo facilities. We now can provide repos up to 12 months. We have started with the 3 months Repo, and based on what we see in the market, we are ready to deploy the other maturity should it be so required. In addition to that, on Friday last week, we also made an announcement about some regulatory relief that we provided to the banks. And the regulatory relief took place on 3 fronts. Firstly, the lowering of the liquidity coverage ratio to 80%. In terms of the Basel III rules, the LCR is there to be used during times of stress. And the South African banks had always had higher LCR than the requirement, to an average around 130 to 140%. And part of that has to do with the fact that with volatility in the financial market and the fact that they have to mark to market their high quality liquid assets now and then, they were then in a position where they felt that they had to build buffers. So we have allowed them now to say that the LCR could drop to 80% instead of the 100%. We have also released the Pillar 2A capital buffer, which is something that is over and above what is actually required in terms of Basel III, and that we allow the banks to dip into that but also to say that should they encounter any stresses going forward, that they would also be allowed to dip into the capital conservation buffer. At the moment, there have not been any need for them to dip into capital conservation buffer. It looks like they could still just do with the Pillar 2A. And lastly, that we have to provide guidance in terms of IFRS 9. IFRS 9 that in the current environment basically meant that without any regulatory guidance, this could actually amount to pro-cyclicality. And we have provided guidance for the banks to the effect that they should actually, in their models, avoid pro-cyclicality. So, the kinds of support that we have given to the South African economy and the South African financial system, an adjustment in the repo rate, the provision of liquidity through the repo market, the provision of liquidity through bond purchases, and lastly, the regulatory relief that we had given. That's where we are, and then I'm going to hand over now to Chris Lovell to take us through the presentation, which is basically a summary of how we view things in terms of the MPR that we are releasing today. Chris?
Okay, thank you. Let me just get the presentation up and running. I hope everybody can hear me. Thanks, Governor, for the introduction. Obviously, the MPR comes at a time of pretty unprecedented challenges and changes in our outlook on the economy. I'll start with this slide, which is just an obligatory exhortation to prudence at a time like this, and we'll come back to those points later on. Just to give you an overview of where we are, the COVID-19 is clearly the biggest shock to hit the global economy since Lehman Brothers bankruptcy, and I'll show you a little bit about what those kind of GDP numbers look like at the moment. The South African economy is very likely to contract by somewhere above 2%. So our initial estimates, say a week ago, showed a contraction of about 2%. And we, as new data comes in, we're revising our forecast on an ongoing basis, and we're likely to come in worse than that, unfortunately. Monetary policy has space to continue to provide accommodation to the economy, given the lower inflation trajectory that we've had, and I'll talk a bit about what that looks like and where we've come from. But clearly a stronger recovery for the South African economy needs a nice term that's been used often around the world recently, this sort of bridging from short-term problems that we have now into stronger growth in the longer term. And we'll talk a little bit about what that looks like. The governor's given you a pretty good overview. Thanks. We've seen clearly a sharp decline in global growth forecasts. What I'm showing you here is just the March 2020 forecast in red, and then comparing that to our latest forecast. And this is a forecast that is ongoing all the time. The forecast teams are taking new data and applying them to their models on a continuous basis now. But the latest forecast of our trading partners' growth looks something like between -3% and -4% for 2020, before seeing a pretty sharp recovery at this stage in 2021. We've seen also a massive spike in volatility and a huge flight to dollars. The VIX volatility index is showing you I'm showing you on the left-hand side, and you can see how the current volatility spike compares to what we saw in the global financial crisis. It's a bit sharper, a bit higher, but very similar in magnitude. On the right-hand side, I'm showing you what's happened to the value of the dollar measured by the Bloomberg Dollar Index over time. And you can see again, right on the far right-hand side, that very sharp pickup in the value of the dollar as institutions and investors reach for dollars at a time when they want to hold safe haven assets. You can also see how the dollar evolved in recent years, quite interestingly. So between 2014 and 2017, the dollar went up quite a lot, in part because the US economy was recovering much faster than much of the rest of the world at that time, but also because the Fed started to raise interest rates, in particular, running from 2016 into 2017, and that boosted the dollar quite a lot as well. As 2018 progressed, you can see that the European recovery started to allow for a normalization in the euro against the dollar, and the dollar index weakened slightly. But anyway, we're really at a very high level for appetite for dollars globally. So what are central banks doing around the world to respond to the COVID-19 shock? Well, one thing clearly is that they're cutting interest rates and expanding their balance sheets. On the left-hand side, I'm showing you the G3 interest rates. That's the weighted average of the US, Euro area, and Japan that we use for our QPM model. And you can see how that's come down very, very sharply with the cuts in the US rates. And on the right-hand side, the US Fed balance sheet, which has spiked up very strongly in 2020 as the Fed started to buy assets. Somewhere this morning, I saw that they were buying $1 million of assets a second over the past 2 weeks, to put that in perspective. We've also seen a sudden stop in capital flows to emerging markets. This data includes China, and you can see how over quite a few years since the global financial crisis, the emerging market universe was experiencing some reasonably good inflows all along, really, until about 2017, when these things started to weaken quite a lot. And then as 2020, we entered 2020, the flight to safety and safe haven assets emerged very strongly. And you can see that that's about a $70 billion of outflows out of emerging markets. I think the South African number is probably about $6 billion at this stage. The good news, I suppose, is that emerging markets have more policy space available now to respond to these kinds of problems than they might have a little while ago. On the right-hand side, I'm showing you the emerging market inflation. It's an unweighted average of the countries below there. It includes China. And you can see how emerging market inflation was ticking over at around 4 to 4.5% through that post-global financial crisis period running from 2010. And then from about 2016 on, there was a quite clear, noticeable deflation or disinflation of emerging market inflation rates. You'll see South Africa's just now. South Africa stayed up around the 4.5 level, but we were at a higher rate before that. So we also experienced some disinflation in tandem with other emerging markets. But you can see how that overall emerging market inflation rate came down to about 3%, and that deflation or disinflation enabled emerging markets across the board to cut rates, and we're seeing that on the left-hand graph, where we just show you the changes in basis points by a range of countries since the 31st of January. Turkey has cut the most. South Africa, Peru, Czech Republic have all cut by about 100 basis points. This is since January, so it doesn't include the January cut. And then you've had some pretty big moves by Mexico, India, Brazil, Chile, and other countries as well. Moving to South Africa, you can see here that our inflation rate is also lower. So the point I made on the previous slide just about South Africa's inflation rate following the same kind of trajectory as other emerging markets is clearly evident here. So in that sort of period between 2011 running up to 2016, 2017, you had inflation coming out at around 5.5% to 6%. You had the very sharp oil price drop in 2015, 2016, which contributed to headline inflation coming down strongly there before picking back up. But then we've also had this really good moderation of inflation coming down to that midpoint of the target at 4.5%. And in fact, even undershooting that midpoint over the course of much of the past year. And our 2020 inflation rate at this stage looks like it's going to average about 3.8%. We've had a bit of a pickup to 4.6%, largely due to petrol prices. Expectations are better anchored, close to the 4.5%, something we've talked about a lot for the last couple of years. And obviously that is a very pleasing view because it says something about households and firms' expectations of inflation into the future. This is 2-year ahead inflation expectations, and that's positive for our trajectory for inflation. There's been a collapse in world oil prices, which also helps to push down on that inflation rate. I'm showing you the evolution of the crude oil forecasts and the petrol inflation forecasts for South Africa in the left and right-hand graphs respectively. So if you look at oil on the left, you can see that at the time of the previous MPR, that dark blue dotted line, you had oil price sitting at about $65 a barrel. That came down very, very sharply for the March forecast, all the way down to about $35 a barrel. But the current oil price, well, it's bumped back up again, but it has ticked down below around $20 a barrel for a couple of weeks now. We'll have to see how this goes forward. If we judge by the latest forecast, that light blue line's trajectory, our March forecast probably isn't so bad, and there isn't too much risk coming from the oil price there. The translation to petrol prices is on the right-hand side. Again, the same kind of trajectory, much sharper deceleration in petrol prices than we had expected not very long ago. Weak demand also remains disinflationary. I'm showing you again the previous MPR, that's the blue line, compared to the March 2020 forecast. When we update our forecast for the next MPC, we will probably see another output gap expansion below that red line, and that will, of course, pull down, all else equal, on the inflation rate going forward in our forecast. The exchange rate works in the other direction. It's adding to inflation. Here I'm showing you again the previous MPR and relative to the March 2020 forecast, as well as the blue line, which is that's our evolving kind of forecast sense given the currency movements that we've seen lately. So this is not necessarily a forecast that will stand for the next MPC meeting, but it gives you a sense of the magnitude of the currency depreciation that we've seen. And that will play some role, certainly, in adding to inflation pressures going forward if that forecast materializes. We've been lucky. Pass-through to inflation has now been lower. What I'm showing you here is over very long periods of time, going back really to the mid-1990s, how the rand per dollar nominal exchange rate has moved at various times of crisis, and that's in that upper part of the graph, and the spikes, and we've labeled the different crises periods: 1998, 2001, 2008, 2015, 16, and then 2020. And then compare that to what's happened with the actual repo rate on the bottom part of the chart. And the point about a policy framework like inflation targeting is it's meant to do exactly what you see here. It's meant to build credibility of the framework over time, and to convince households and firms that when there's a big exchange rate shock or other type of inflationary shock, the probability of inflation after that shock going up very high is lower. And what that means is that the repo rate doesn't have to move as much. And this is a classic kind of view of what happens when you get a good monetary policy framework in place. over time those repo adjustments go down. And we've seen that very neatly on the right-hand side of the graph with the later RAND shocks playing themselves out as very, very minimal repo adjustments. Oops, I'm going in the wrong direction, yeah, sorry. Import prices are also deflating, so not everything is about pass-through. We worry a little bit about putting everything down to pass-through. And one way of looking at that is to look at how import prices are deflating. And we're showing that here with the blue line on the left-hand side graph compared to the CPI components that we match them to. So the UVI is the unit value indices for a variety of imported goods measured in RAND terms. And what you can see on the right-hand side of that graph is that for quite a few of those UVI components, it's actually deflating. And if you took out certain types of components, you would get that blue line would be even more moderate. So you're getting some deflation of certain types of imported goods prices, but you're still getting a positive CPI on those same goods. And that suggests that there is some pass-through. So we have to watch that pretty carefully to understand what's going on there and to think about the risks posed by it. When we take a step back and look at the inflation forecast for this year that we've got, the good news, I think, is that the inflation forecast is likely to remain the bottom half of the target for this year. The fan chart on the left shows you the forecast that we have and the distribution probabilities. On the right-hand side, we break that down in a little more detail and make the point that 59% of the probability distribution is sitting to the left, so sitting below the 4.5 inflation midpoint of the target band. The economy is expected to contract in 2020. As we noted, here we provided a very long-term view of GDP, real GDP growth in the economy. We haven't seen that blue line come down right at the end on the right-hand side yet, but we will for 2020. But in comparison, you might note here that in 2009, we saw something like a 1.5% real GDP contraction for the year. 1992, that was 2.1%. And back in 1983, that was nearly 2% at negative 1.8%. So in the past, there have been some pretty big contractions hitting the economy associated with very large shocks. This graph tries to give you a sense of the evolution of our forecast going forward. These are not numbers to be taken literally at face value, but it tried to demonstrate the kind of uncertainty associated with forecasting when we get hit with a shock like we're having now, which is both a supply shock combined with a demand shock. This graph, we're just trying to show you a kind of illustration of what 21 days of shutdown might look like from a purely supply side point of view on 2020 growth. So we make a variety of assumptions about what happens in each of these sectors and how much of a negative growth or a zero growth do they actually exhibit over those 21 days. There's a lot of detail behind this, but it just gives you a sense of the kind of growth shock that you could get. So that's negative 2.6% for a level of real GDP over the course of the year, just by having 21 days of shutdown with different assumptions made about how that 21 days impacts across all of these different sectors that we've outlined here on the right-hand side. Again, these kinds of numbers are very uncertain and will move around a lot. And back on stream post-lockdown. So how long the shutdown lasts, and then the rate of pickup after the shutdown. So that's on the supply side. Part of the difficulty with a crisis like this is that it's not just supply, it's also demand. And so one of the things we're also trying to do is estimate what kind of demand shock we might get. And two variables that we want to look at there are job losses and business failures. And again, this is giving you a sense of very early numbers that we are playing around with in our forecasting process about what that might look like. You'll see on the left-hand side for the formal sector, the shock that we see could end up being something like a 370,000 jobs lost in the formal sector. And on the right-hand side, we'd be looking at something like 1,600 businesses go insolvent in 2020. So these are big numbers, and how those carry through will shape a lot how the demand side of the forecast equation goes. Let me move on to the last few slides. The economy was in recession before COVID-19. As you can see, these are just the quarterly numbers, -8 and -1.4 in 2014, 2019's Q4. The past decade, it's worth pointing out, is also one of the worst for growth on record. These are real index GDP levels. The 2010s is the red index, and you can see relative to all these other decades, it grew by less, even less than the 1980s and the 1990s, which the 1990s barely caught up with 2010s. Part of the problem is that the electricity shortages became more acute, a theme that we've touched on before. The electricity availability factor fell to very low levels. And on the right-hand side, you can see how electricity falling has translated into mining and manufacturing doing very poorly indeed over the past year. The rest of GDP is a little bit higher, although if you take agriculture out of that, it would be a little bit higher still. Agriculture also had a difficult year, and this graph just tries to give you a sense of why that's the case. Different types of crops did pretty poorly in 2019 relative to what was expected. So where does that leave us with the growth outlook? It's uncertain into 2021 and 2022. This is a graph that gives you GDP, real GDP in level terms. So if we go back to the January 2020 forecast, we would have seen a trajectory of that level looking like the black line. By March, we were looking at something like the red. And now with our latest kind of revisions to the forecast that we're working on, we're looking at something like that blue line, and the downturn obviously being the hit from the COVID-19 shock. The fiscal position remains extended and potentially considerably more extended than it has in quite some time, going back really into the sort of early 1990s. And the long-term lending costs continue to rise. So as the shock has hit, 10-year bond yields, which had ticked up for quite some period in recent years, as you can see on the left-hand side, in nominal and real terms, very steady progression upwards, suddenly spiked this year with that flight to safe havens and the riskiness of the South African economy taking center stage, certainly with the credit rating agencies. The term premium on the South African 10-year bond is on the right-hand side of this screen. You can see that has gone up quite a lot as well. So emerging market risk is generally up, but South Africa has gone up higher, unfortunately. This graph is trying to demonstrate that. We have unpacked the domestic portion of that risk alone from the global portion. So some part of that blue SAEMBI plus spread rising is just a function of risk aversion hitting the global economy very hard, and all emerging market assets being sold off or being perceived to be much riskier. And we've unpacked that away from the domestic portion And so you can see how with the red component of the EMDI also generating a higher risk perception. The yield curve, if you kind of add all together all those last three graphs I've shown you, is now very steep. This is on the 30-year bond compared to the 2-year bond. Over time, that's yield curve's steepness has accelerated in line with that increase in the long-term yields. And all else equal, that tends to weaken the policy impact of trying to get growth going in the short term. The repo rate is down to 5.25%, its lowest rate since 2014, and you can see here very clearly the trajectory of the repo rate over time, and it's ticking down in response to weakening growth outcomes in the latest period. So what has that done? Well, one thing it's done is it's freed up some cash for households and businesses. We worry quite a bit about the impact on growth because your interest rates are normally thought of as having a pretty good impact on growth when conditions are appropriate for households and firms to continue borrowing. We're not sure how that's going to play itself out this year for obvious reasons. But we did try to do a bit of a back of the envelope calculation of what it looks like for households and firms when that interest rate got cut by 100 basis points. And our very rough estimate will show you that it puts out about 32 billion rand back out of banks and into the hands of firms and households to help certainly with cash flow issues. This gives a graph, just shows you a bit about how that liquidity support has helped with the financial market and its functioning. I'm sure you'll have questions on that. But the basic point here is that liquidity support did help to deflate the rising bond yields that were escalating for a few days in March. The x-axis is days of March, just so you know. So the graph that I'm showing you here is just how that long-term bond yield picked up very steeply in the middle of the month, and then what the short-term impact of the liquidity support provided. So let me conclude. COVID-19 is a major shock to an already weak economy. Monetary policy space has certainly opened despite currency weakness, and we think that's a positive. Hopefully we can help continue easing the cost of adjustment and bridging to recovery. But broader reforms are probably crucial for improving the long-term growth trajectory of the South African economy. Thanks.
Thank you very much, Chris. Obviously, because we are not in the same room, you guys couldn't field the questions. So we had improvised. We asked you to send us a list of questions that you might want to ask, and we will deal with the questions that were sent in writing, and then after that we will take any follow-ups from those questions that had been raised. So now, and I will group these questions. Chris, there are questions about the forecast for GDP and why it is tentative. I'm going to throw that back at you. You will deal with that. Let me deal with these questions, and then if there are follow-ups, then I can throw them back to members of the panel. Renee had asked a question, please, about our calculations of the impact of the 21-day lockout. I want you to deal with that as well, together with the forecast question. There was a question about what we say in the MPR about the possibility that the deficit could exceed 10% of GDP. And as to whether this thing refers to the fiscal year, yes, it refers to the fiscal year 2020, 2021. Obviously, this is a very early estimate. It's just based on if the same thing that we have seen happening with expenditure stays in the system, and the fact that GDP would contract and revenue would come down. So a combination of all of those would lead to a higher deficit. What that deficit would be, we cannot quite pinpoint it at this stage because we do not know the extent of the lockdown. Suffice to say that we expect that the deficit will be higher than what was initially announced. If there are any spending revisions, that's for the guys up the road to deal with. And there's this favorite question that keeps on coming all the time about whether we have considered moving to monthly meetings. No, we have not considered moving to monthly meetings. We, however, continue to watch the data, and if the data is such that we might end up having to meet earlier, we could meet earlier. There is nothing that stops us meeting earlier, but we are not switching to monthly meetings. There were then questions about international facilities, about the fact that the Fed had made available a repo facility, and whether we think that the SARB qualifies for such a facility. Our initial assessment is that we would qualify for such a facility. This is not free money. It is based on the holdings that the central bank has with the Fed, and what this offers is that you could actually pledge those securities that you have with the Fed as a collateral in return for a facility. This is supposed to be market stabilizing. It's supposed to be market stabilizing because what we have seen since the COVID breakout is that central banks have been liquidating their assets to access dollar liquidity. And I think a facility like the one offered by the Fed would mean that central banks could thus access dollar liquidity without necessarily having to sell their holdings of US Treasury securities. So it's a welcome facility, and we will start our conversations with the Fed and communicate at an appropriate time. There's a question from Lindy that asks about whether the staff could give an indication of how much of government bonds it had bought in the secondary market thus far, and how much more it envisaged is buying. Let's be clear. The reason why we entered the bond market to buy government bonds was not because we are trying to drive the yield curve. Neither was it done because we want to fund government. Actually, the reason why we entered the bond market was because, as I said in my earlier introduction, that when we saw a dysfunctionality in the market, we felt that as part of our mandate of having a functioning financial system, we were duty-bound to make sure that we continue to have functioning financial market. Why is this so important for a central bank? Remember that the implementation of monetary policy is through the financial markets, and thus impacting on the interest rates in the financial markets and eventually what households and firms end up paying in terms of interest rates. So, after the March MPC, we noticed that what we saw in the financial market was that the rates in the financial market didn't easily follow the adjustment in the policy rate, that is the money markets. It didn't follow the adjustment in the policy rate. Hence, our entry into the repo market, providing additional repo facilities to make sure that the monetary transmission mechanism does actually take place. The bond market is also important because the repo market is functioning on the basis of collateral sourced from the bond market. And as such, when we saw that the bond market was starting to depict some dysfunctionality, we felt duty-bound to enter into the bond market to make sure that transparent price discovery takes place in the bond market. How much have we bought, and how much we have bought is will come as part of the release of the SARB's balance sheet. At the end of every month, we release the SARB's balance sheet. That is where you would pick up that figure. We will not release any interim figure. How much do we intend to buy? We can't say how much we intend to buy because we go into the market to buy because we are seeing dysfunctionality. So how much we buy in the future depends on whether the financial market, the bond market, continues to function or depicts some form of dysfunctionality. And if it shows some dysfunctionality, we would step in and continue to buy the bonds. Remember, at the moment, the dysfunctionality was coming on the one side that we could buy bonds. We are always engaged in open market operations. We can buy, we can also sell bonds, depending on where the market stresses are, if there are any market stresses. Lindy, you asked the question that the bank had indicated that its growth forecast and inflation forecast could be revised lower. Well, that is part of what Chris will deal with. The question, or I've dealt with the fiscal question, and there was the question of what is the bank's view of the impact on the deficit in the light of downgrades by Moody's and Fitch. All that we know is that if there is a downgrade, you are repriced and the cost of capital in the economy goes up. How much, by how much, it is something that depends on what actually happens in the market. Therefore, you ask the question, under what circumstances, if any, would the SARB consider using reserves to tame the sell-off of the South African rand? No, it is not the role of the central bank to tame the markets. We have repeatedly indicated that the rand value is determined by forces of demand and supply in the foreign exchange market. And that for as long as there is adequate price discovery in the foreign exchange market, there is no need for the SARB to enter the foreign exchange market. Yes, spreads have widened in the foreign exchange market. Bids offer spreads have widened. Yes, people might not like the price that they see in the foreign exchange market, but one thing they can't complain about is that there is no prices. There are no prices shown in the forex market. So there are prices shown in the forex market. As previously indicated, we would only get involved in the foreign exchange market if we see that there is dysfunctionality in the forex market such that it would impact on the adequate transmission of the policy stance that we actually take. And Chris will deal with the GDP forecast. And there was a question of what has been the impact of the COVID-19 crisis and subsequent rate cut and liquidity interventions on where this bank saw the country's risk premium relative to the rate premium. The country risk premium, Chris, you will deal with that, is part of the QPM, how we look at the country risk premium. And then question of what is the interaction between the benchmark lending rate and the government's debt, and whether we have engaged the Treasury to find a suitable rate. There is one thing about the bond market. You are a price taker in the bond market. The only thing you control is quantity as an issuer. So if you do not like the price in the market, you are faced with two choices. You either cut on the issuance that you have, or you walk away. And if you walk away, you must know that you must live with the consequences that you then do not have funding, which then says that you will have to go and look elsewhere, whether you are looking at the multilateral, like the IMF, the World Bank, or the NDB is another matter. But we have spelled out that the yield cap, you could see from the yield cap that the yield cap is very steep, which means short-term rates are very low and long-term rates are elevated. And the long-term rates are elevated, partly reflective of the country risk premium, partly reflective of what could be coming in the form of issuance, partly reflective of the fact that there had also been an outflow of capital from the emerging markets, and that South Africa is no exception. So the fact that the yield cap is so steep is also reflective of that, but it then shows to you that the reason why you have got high long-term bond yields has got nothing to do with the monetary policy stance. The last question was whether the buying of bonds had yielded any desired result and how we measure that. As we have said, our desire is to see a continuing functioning market with adequate price discovery. As things stand, it looks like there continues to be price discovery, and that is where we would leave it. And as I said, our entry had nothing to do with trying to influence where the bond yields are. To the extent that bond yields declined, it was simply an outcome of the fact that the market started to function better than it was before the SARB provided the liquidity in the secondary market. Chris?
Okay, thanks, Governor. Look, I'll try to deal with all the growth questions, forecast questions in one go. Let me just say that everything is very tentative for the obvious reason that the data that we base our forecasts on is always behind the curve. So you will have seen the PMIs from last week telling a kind of story that isn't up to date with what we think is happening during the lockdown. And we're not going to get a clear view of what's happening with the lockdown until later on when data starts to roll out. So much of the thinking around this has to be kind of about assumptions and looking at history and trying to understand what's happened in past crises and when growth has taken big hits. So, for instance, the business closure numbers or the employment numbers are extrapolations of what has happened in the past. We haven't really taken any particular view on which sectors and where businesses are going to close, but obviously sectors like tourism and transport are going to get hit harder. Sectors where there's more service activity will get hit much harder. But by the same token, those are sectors that are easier to bounce back. So, it's quite unclear how to think about the way in which the economic impact unfolds over time. And that basically means that our estimates are really very, very tentative. My forecast team, as I was trying to say earlier, is sort of moving on to an ongoing rolling forecast. And so our numbers literally from day to day are evolving as we think about, appropriate ways of thinking about them, try to understand what's happening in other economies, and try to get information on the ground from what's happening here. And it's really pretty difficult. And so while it makes a lot of sense for us to give you some ballpark estimate of what numbers look like, they are really uncertain. If you, one of the questions was about what happens if you go beyond 21 days. Well, first of all, the negative 2.6 is 21 days from a supply side perspective. It doesn't include the demand side. And the demand side might moderate that quite a lot. If you doubled the number of 21 days and had a shutdown for 42 days, you're obviously going to get a much bigger both supply side hit as well as follow-on demand hit to the economy. And so that's why when you look at the range of analysts out there, you'll see estimates of GDP losses for the year running from, I think the lowest I saw was about 1.5% of GDP, rising up to sort of negative 8%. And those are big numbers. What matters also quite a lot is how you think about the quarterly evolution of the numbers. So, a number like -4 for the year would come from a quarterly drop. So the Q2 hit to the economy of something like -20% quarter on quarter. But then a lot depends on how the annual number depends on how that rebounds and the speed of the rebound. So if Q3 is +10, you're going to get a very different 2020 annual number than if the number comes out at 0 for Q3. So this really is work in progress, and it's great to have a wide range of analysts out there providing estimates for this. It helps in our thinking about how this thing is going to unfold. A lot also depends on just the policy reactions to things. So, if Treasury spends more money with fiscal policy, the ways in which the private sector reacts to the slowdown matters a lot. I would say, as a slightly more kind of optimistic note, that it is quite clear that South Africa was ahead of the curve in many ways, and we can see that in the ways in which businesses are talking about how to respond to the crisis. And that's really very positive because in many parts of the world, businesses were caught completely unawares and unable to even think in advance about what to do. A lot of the recovery to the crisis will depend on the ways in which businesses get back on stream safely. So one of the things that we've learned about COVID-19 and pandemics of this kind is that they can go in waves. So the idea that you have one shock and then it's over is not very realistic. But that gives you a clue as to how companies need to think about future waves of the virus coming out and the ways in which they need to take steps to prevent it while coming back on stream and getting their economic activity going. So, the more innovative companies are in doing that will say a lot about the way in which the economy comes back over time. And at this stage, it's really too early to tell. Our potential growth rate was marked down quite a lot for the March forecast. We will probably mark it down a little bit going forward, but I can't tell you, Miriam, how big that markdown would be at this stage. we're still thinking about it. The neutral real rate and where does the rate come out relative to that? The March clearly was a decisive step towards cutting rates in a way that would drive the real rate level well below our estimates of the neutral real rate. So our neutral rate hasn't changed a lot. It stays at around roughly 2%. And the reason for that is that even though domestic growth continues to underperform, the risk premium keeps rising. And so those sort of contrasting forces have kept the neutral real rate relatively stable over time. It does move around a little bit from time to time. So when the Fed cut rates, it pulled it down slightly, but it hasn't moved much. Going forward, if a contracting economy pulls down on inflation more, then that real rate relative to neutral will push back up again. And that's kind of what we have in mind when we think about risk to the inflation forecast. So if they are to the downside, it would tend to create more monetary policy space. The problem is that we've seen with this kind of risk-off global environment that the currency is depreciating. And so we have to think about the way in which that feeds back into the inflation forecast going forward. So it isn't just about lower GDP growth. It's about how these things balance off each other over time via the forecast. But they do play themselves out over different time frames. And so we would also think about when these kinds of different shocks hit the inflation rate and what it does to that real interest rate level relative to neutral over time. I think I've handled most of the questions, at least indirectly, Governor.
Yes, indeed. Thank you. Rashad, Kuben, Fundi, is there anything you want to add or something that you want to clarify? I see your microphones are muted. Are you going to all say no, or are you going to just keep quiet and say silence is consent?
Governor, I should just clarify one thing. So in terms of, I think Funeko had a question around the outflows to date of bonds. So the outflows that we've seen come close to around 58 billion rands for the month. So I guess with the current risk-off environment that Chris was highlighting, one would have to watch what is happening in the area of capital flows.
And those who have bonds, do you have equities figures?
I have to check on the equities figures, Governor.
Okay. Whilst you are checking, Rashad?
Yeah, just to add one or two additional things that Chris raised. The one question I saw as Chris was talking came in is will there be permanent loss to the economy? And that's an interesting question because we have this problem of not being able to distinguish firms who may have closed down independently or innocent of the virus on the back of a technical recession versus firms that are now affected much more seriously by the virus. I think the key question is the extent to which firms are able to sustain themselves for a period of time, depending on the length of the virus. If for some reason, with some kind of relief, firms are not able to sustain themselves, these are firms that simply go into our liquidation statistics. And essentially that means that, there's a fundamental structural break in our potential output, that the potential output has to be revised. So one of the reasons why there is widespread attempt by many governments to provide relief is a function of the fact that firms that are purely suffering as a result of the virus, not because of any other factors, may be able to survive if there's some sort of relief. If that relief doesn't come on board, these firms will close down. So I think that there's bound to be permanent income loss. The extent to which that income loss will sustain itself will depend on, obviously, the usual things, the length of the virus and so on. Thanks.
Thank you very much. We forgot literally 5 minutes. Are there any other questions for clarifications? You can raise your electronic hand. I see that people like Mfuneko are very sophisticated. They were able to pose their questions on the system. Well done, Mfuneko. Okay, I see Miriam. Okay, you don't have a question. Okay, so
I don't know how to ask a question.
You are live. Go ahead, Miriam.
Oh my goodness. Okay. I was wondering, given that we've seen massive bond outflows already, what sort of outflows do you expect when we drop out of the World Government Bond Index at the end of April?
Thank you very much. Any other question? Okay, thank you. So, Miriam, the answer will not be much different from what I provided in the past. We don't know whether the outflows that we have seen recently were front-running the fact that we are going to fall out of the index, or they were simply part of the emerging market route. So it's very difficult to then say how much more do we still expect to flow out. Okay, and Mfuneko, Chris have answered your question and have split it into bonds and equities. Thank you very much, Faraya. Back to you. I am done.
Thank you, Governor. Can I just do one final check to make sure that there are no outstanding questions? Thank you very much, Governor and panel. Thanks to the media. We hope that you found the press conference fruitful. If there are any other questions beyond this, please be in touch with Ziyanda or myself. Thank you very much.
Bye-bye.